In a time when banks offer very low interest rates on savings and the economy is unpredictable, leaving your money in a bank account may not be the wisest way to preserve or grow it. Instead, the secret to sustainable financial health lies in investing in various assets that can provide better potential returns and safety compared to traditional cash savings. In today's video, I'll discuss 7 such assets with a remarkable track record of outperforming cash savings regarding safety and return on investment. Watch this video until the end. With that said, let's have a look at these assets. Asset number 1 is gold. For the past 50 years, holding gold as an asset has long been regarded as a safe haven, so it's often seen as a preferable option to keep in cash. Here's why. Firstly, gold acts as a reliable hedge against inflation. When currencies and other assets suffer negative real returns, gold retains its value as a physical asset because it can't be created at will like fiat currency. As the cost of living rises, gold tends to increase in value, so gold owners are protected from the devastating effects of inflation. Secondly, gold could also serve as a hedge against currency risk. If a particular currency's value plummets, it can lead to a higher gold price in that currency, which can be very beneficial for people living in regions with unstable or hyperinflationary economies. Furthermore, gold is universally accepted for its value, even if a fiat currency's value declines. Gold's recognized value remains consistent in the financial markets worldwide. Despite its advantages, gold has its risks. For instance, its price can be unstable in the short term, and it doesn't generate income through dividends or interest. Additionally, there are expenses associated with gold storage and insurance. So before including gold in your investment plan, you should carefully consider the potential risks and costs associated with owning it. Asset number 2 is land. Land ownership, like real estate, can be an excellent substitute for a traditional bank account, and it comes with unique advantages worth considering. One major benefit is that land appreciates value over time, especially in growing or developing areas. Unlike properties or homes, land doesn't lose value due to wear and tear or age. Instead, its appreciation is influenced by factors like location, zoning, and demand. Depending on its location and characteristics, land can be used to generate income. You can decide to develop the land, sell it, lease it, or even hold on to it while it appreciates. Unlike commercial or residential properties, vacant land requires less maintenance and has fewer associated costs. For instance, there are no utility bills, mortgage insurance, maintenance, or repairs. Another key advantage is the scarcity of land. Unlike other assets, land cannot be created, and this makes it a valuable asset, especially as population growth and development drive up its demand. Additionally, land can serve as a hedge against inflation, much like waste. This is because, as the value of currency decreases, the prices of goods and services, including land, typically rise. However, owning land does come with challenges. It can be less liquid, meaning it may take time to sell, and it doesn't provide immediate income unless you lease or develop it. Additionally, land ownership comes with extra costs and complexities, such as property taxes, zoning laws, and environmental considerations. Asset number 3, real estate. Investment offers numerous advantages that make it a preferred choice for many people compared to keeping money in a bank. First and foremost, real estate usually appreciates in value over time, giving you significant profits even during market fluctuations. Furthermore, if you decide to rent out your property, you can get a steady stream of income that is often higher than what you'd get from bank interest, making it an excellent option for retirement planning. Real estate also serves as a hedge against inflation since property prices and rental income tend to increase along with the rising costs of goods and services. Additionally, as a real estate investor, you can benefit from tax advantages, including deductions from mortgage interest, property taxes, and rental property management costs. One of the unique benefits of real estate is the opportunity for leverage. This allows you to amplify your investment returns by using borrowed money to purchase a more valuable property. Moreover, unlike many other investments, real estate provides you with control and flexibility, enabling property improvements or repurposing to suit your needs or market demands. Lastly, including real estate in your investment portfolio can also contribute to diversification and risk reduction, as its performance is not directly linked with the stock or bond markets. But despite its advantages, real estate also has risks and downsides. For instance, it requires constant maintenance and repairs and is not as readily converted into cash as other investments. Additionally, various factors such as changes in the neighborhood or real estate market can impact its value. So before you make a real estate investment decision, you must do thorough research and consult a real estate professional. Asset number 4, money market funds. Whenever financial experts talk about shifting parts of their investment portfolios into cash, they usually mean allocating it to money market mutual funds. But what is a money market fund? Well, this is a type of mutual fund that invests in short-term, low-risk, and highly liquid financial instruments. These funds provide investors with a safe and easily accessible place to keep their cash and manage their short-term cash needs. These funds invest in short-term debt securities with high credit quality, like treasury bills, commercial paper, and certificates of deposit, which are known to be very reliable. Money market funds offer several advantages. For instance, they come with low fees, provide quick access to your money whenever you need it, and are generally considered very safe. Additionally, these funds issue redeemable shares to investors, making it easy for them to buy or sell shares at a steady net asset value of $1 per share. But like any mutual fund, money market funds cannot guarantee profits or protect your initial investment from loss. However, their strict terms make them safer than other investment options. Asset number 5, treasury bills, notes, and bonds. U.S. Treasury securities are widely regarded as one of the safest investment options globally. That's because they are fully backed by the U.S. government. Usually the U.S. government sells investment products like savings bonds, U.S. Treasury bills, and notes. Raise funds for its operations. When you invest in these products, you are basically lending money to the government, and in return, you earn a profit on your investment. It's a reliable and patriotic way to support the nation's financial needs while growing your own money. Government bonds come with fixed terms and interest rates, while Treasury bills have varying maturities of 4, 8, 13, 26, and 52 weeks. Treasury notes, on the other hand, offer maturities of 2 and 10 years. If you're looking for longer-term options, Treasury bonds come with maturities spanning from 20 to 30 years. Understanding these differences will help you select the option that aligns best with your financial goals. So take your time to evaluate each one carefully and choose wisely according to your needs and preferences. With Treasury securities, you don't have to worry about market demand. Compared to other investment options, the market for these securities is incredibly huge and highly liquid. This means you can easily sell Treasury bills, notes, or bonds without any difficulty. If you ever need to cash out before their full maturity days, you can purchase these Treasury securities directly from the government website. But before you do, consult with a financial expert to help you find the suitable investment to help you reach your financial goals. Asset number 6, S&P 500 Index. Investing in the S&P 500 Index is often considered better than keeping your money as cash because it has the potential to give you higher returns over time thanks to the power of compounding. S&P 500 Index includes a wide range of companies in the U.S. stock market. Historically, it has offered much better returns than the interest earned from a regular savings account. Since its creation, the S&P 500 has generated roughly 10% annual returns through capital gains and dividends before inflation. What's more, an S&P 500 index fund is a passive investment strategy, which means you don't need to have extensive knowledge about individual companies or spend a lot of time researching them. This makes it a much more straightforward investment approach, especially for those who lack the time or the interest to actively manage their investments. When you invest in the S&P 500, you're investing in 500 of the biggest companies' various industries in the U.S. In other words, you're not putting all your eggs in one basket since your investments are spread out. This diversification helps to lower investment risks by protecting investors from the negative impact of any single company's struggles. For instance, if some companies or sectors within the index perform poorly, others may still do well. Furthermore, many of these companies pay dividends, which can provide a consistent stream of income that can be reinvested. And by continuously reinvesting dividends, the powerful compounding effect will significantly increase your investment over time. But while the S&P 500 index may seem like a safe bet, it is crucial to understand that all investments carry some level of risk. For instance, the value of the index could fall, leading to potential losses, especially in the short term. And though the average return over the years has been roughly 10% annually, this doesn't guarantee consistent results. So you should assess your risk tolerance and investment goals before getting started. And if the S&P 500 index doesn't match your investment preferences, there is no need to panic. And lastly, when choosing safe investments, you should consider assets that preserve your initial investment, grow moderately, and maintain liquidity for easy conversion to cash. Today, various secure investment options are available, but the best choice depends on your risk tolerance and liquidity risk. That brings us to the end of the video. Thank you so much for watching and staying with me to the end. If you have any comments or thoughts you would like to share, please do so in the comments section below.